Welcome to this webinar on corporate tax responsibility, a dialogue between companies and investors. My name is Valeria Piani, and I'm Associate Director of the ENSNG engagements team within the UN-supported PRI, the Principles for Responsible Investment. And for whom is not familiar with the PRI, we are a UN investor partnership founded and supported by the UNGC. And we focus on the consideration on the environmental, social, and corporate governance issues in financial decision-making processes. So today's call is also a collaboration with the UNGC LEAD, an exclusive group of sustainability leaders from across all regions and sectors that represent the cutting edge of the UN Global Compact. The UNGC has already organized a webinar on corporate tax and human rights a few months ago, and you can actually download the recording of it from the UNGC online library on the UN Global Compact website. However, today's focus is more specifically on the dialogue between investors and companies and on specifically corporate tax strategy. Our goal is to present why and how investors are engaging on responsible corporate tax planning with companies, help the companies to participate and anticipate questions from investors on this topic, learn from good disclosure practices from companies, and of course shape up a more productive dialogue between companies and investors. So with this in mind, we invited two excellent speakers to present investor in the corporate perspective on responsible tax planning. I have Robert Wilson, research analyst at MFS Investment Management, and Clive Baxter, head of corporate tax at Maersk, and Maersk is a lead company with me. And for the duration of the call, you will be muted. However, if you would like, we would like to encourage you to use the chat box on your screen to submit your questions at the end of the speaker's presentations. So please specify to whom the question should be directed when you type it. And if you have any technical issue, just let the UNGC team know. You just need to use the question panel A, or you can just raise your hand if you don't get a response. So let me just get started with today's webinar and just give you a little bit more of introduction on the work that the PRI has done on corporate tax responsibility. You can see coming on the screen the first page of our report. We decided to convene a group of investors, and we created a task force of 11 signatories specifically to produce a guidance who could help the investors to engage with the companies on this issue. And we felt the economic slowdown, growing inequality, increasing media and civil society scrutiny, and also upcoming legislation, if you think more specifically about the OECD base erosion and profit shifting project, are increasing pressure on companies to disclose more on the overall approach to tax planning and also all the related risks. Also, investors felt that there were many reasons to look at tax. Tax is not a cost to minimize, it's actually a key systemic risk, can create earnings risk, can create damage to reputation and brand value, it can of course cause macroeconomic and also societal distortions. So if we move on to the next slide, you can actually see one section of the guidance, which is specifically looking at the first steps that investors have to consider when they want to discuss this issue with companies, which is identify some red flags, some risk in the portfolio, to be able then to identify the companies they would like to have a more broader discussion with. And some of these red flags are related to a large persistent tax gap, which is the difference between the effective tax rate on a company's income statement and the weighted average on statutory rates based on the firm's geographic sales mix. You can also have a look at the growing unrecognized tax benefits balance, and which is actually displaying the tax position being taken by a company that management believes are less than 50% likely to be upheld by a tax authority. And if it's large, it could create potentially an indication of aggressive tax planning. Also, media stories and government inquiries can be another means to understand if there could potentially be issues related to how the company is trying to optimize in tax. And also there are other indications like foreign effective tax rates that are more specifically related to US companies, new disclosure or changes in language used in tax footnotes, if there's no disclosure on geographic revenue mix, if there's lack of a tax policy, and also if there's an indication that a company has multiple subsidiaries in tax havens. And if you move on to the other slide, please, you can also see a list of what are the major suggestions from the task force and the PRI on discussions that investors can have with companies on tax-related issues. The first three are more general and more looking at the governance angle of the issue, and the other three are more technical. So one of the first points that investors could start talking about with companies, do they have a tax policies? Have they considered to publish it? And what are the tax principles to indicate the approach of the company towards taxation? There are also questions potentially related to tax governance. Is tax formally a part of the risk oversight mandate of the board? There are questions related to managing tax-related risk. How is it the company defining managing tax-related risk? What are the top 3 tax-related risks that the company can identify? And then further discussion can be looking at the effective tax rate, what we mentioned before, what is driving the gap between the effective tax rate of a company and the weighted average statutory rate based on the geographic sales mix. And also discussion can be around the tax planning strategies, potentially tax incentives, be present in tax havens, having some level of low taxations. And finally, what is the view of the company on country-by-country reporting, again, based on the evolutions from the OECD project around that, and also the latest legislation and recommendations at the European Commission level. So these are generally the points touched based on the guidance. The guidance is available also on our website. And this will be kind of the framework of reference for our discussion today with our speakers. So without any further ado, I would like to hand it over to Robert, and Robert will give us the perspective of an investor on specifically this topic. Robert, over to you.
Great, thank you. Well, welcome everybody. So as mentioned, my name is Rob Wilson, and I work at MFS Investment Management as search analyst. And if we move to the next, to this slide here that we see, I put together the agenda for my portion of today's event because I wanted to start out here by orienting everyone, I guess, to 2 things really. First, I wanted to orient all of you to MFS because I think our investment process really drives some of our interest in this topic. And second, I wanted to orient you to the way that we think about and handle tax risks for that subset of companies where we have concerns. And certainly it's not all companies where we feel like there's risk, and I want to make that clear at the outset. So what I'm talking about here is those where we do identify a particular area of risk, and I'll show you, or I'll talk about how exactly we go about doing that. So moving to the next slide, MFS has been around for a long time. In fact, we created the first open-ended mutual fund in 1924. So we've been around for quite some time. And although our asset base is over $400 billion, quite large, our investment process is really consistent across all of our portfolios. Most notably, we have a very long-term focus. And I think a lot of asset management companies, will say this, but I think the way that we think about it is that our 2 largest funds, which are over $100 billion in assets under management, have over a 7-year average holding period for those 2 funds, for the companies in those funds. So we really are truly seeking companies that can produce sustainable returns through an economic cycle. And as a result, we're doing, we need to do deep fundamental research to be able to do that, and we need to really emphasize a real risk awareness to be able to feel comfortable holding securities, buying into securities, and holding them for that amount of time. So in essence, we really want to be able to understand every risk and opportunity for each company that we own. And again, I think it's really critical to note that I'm not trying to say that every company is being aggressive with tax. I'm just outlining here how we've analyzed this issue for those companies that we do have concerns about. So now moving to the next slide, slide number 10, what caused tax minimization to enter sort of the collective consciousness of our investment team? I think that's maybe the first question that I should answer. And back in mid-2013, we saw a couple of trends that caused us to really start doing more research on this topic. And these two trends were really what caused us to believe that this issue was going to enter and remain on the agenda, not just for governments, but also for other actors or stakeholders that could impact the dialogue on this. And the first trend, I think, is fairly obvious here. I mean, clearly many governments have very large debts and very large deficits, and yet at the same time, they're faced with growing demands on social programs and infrastructure needs that are substantial. And so we kind of paired that fact up with the estimates that we were seeing of the amount of tax revenue that is lost to, tax minimization or tax avoidance or whatever you'd like to call it. And the fact that appeared fairly substantial, made us believe that this was really something where there were going to be a number of governments who were quite highly incentivized to try to manage those debts and deficits by going after some additional income in this area. Now, as we researched the issue, we also found it interesting that emerging countries are also impacted by this. I think initially we kind of felt like this was more likely to be a developed market kind of problem, but as we dug in, we saw things like the OECD suggesting that developing countries lose 3 times as much to tax havens in tax avoidance kind of activities than they receive in international aid each year. And as a large global manager, we have many investments in the emerging markets. And I think, you could certainly have some questions about the value of another government program in certain developed markets, and that's not a conversation we want to have today, obviously. But I think in emerging markets, it is perhaps a little bit easier to recognize that this isn't a zero-sum game, that there is, necessary infrastructure and other programs that need to be developed in these developing economies to ensure that the companies that we own there are able to flourish and provide the kinds of financial returns that we're hoping for as we try to provide value to the clients who have entrusted their assets to us. So high debts and deficits was one obvious factor that we felt would keep corporate tax on government agendas. Now, if you move to slide number 11, the other reason we felt corporate tax would remain a hot button issue was that many view this topic as an issue of fairness. And I'll say that fair is, I would say personally, somewhat impossible to define. But it's data points like I've shown here on this slide that we felt would continue to give at least the media and other actors plenty of reason or ability to fight against real or perceived corporate tax abuses. And I should note that the main tax structures that led to the chart on the right side of this slide here, where we're looking at the effective tax rate within Ireland of U.S. corporations, many of the strategies that led to this kind of change in that effective tax rate being paid are actually being phased out. So there are some changes that are occurring here, and some, clearly, questionable strategies that, have been recognized and changed already. Now, moving to slide number 12. So if you have high debts and concerns around sort of this, perhaps you might say, elusive concept of fairness, that's going to make governments and others, as I said, interested in the issue. But I think the next question that we asked ourselves was, is there anything that the governments or others can really do about corporate tax minimization strategies? And this is not a minor question. We really kind of fought with this for a while because there are opportunities for companies to, make different decisions as it relates to their tax positions. And so we really wanted to think through whether or not it would be possible for individual governments or for this issue to really be tackled more broadly. And as we started to dig into it, I guess we did believe that that governments would be able to do something about this because we were seeing a lot of signs of unilateral regulatory change and enforcement. Certainly every CFO that we've talked to, even if they don't necessarily view corporate taxes as a major risk for their organization, certainly have noted that audit frequency and intensity has increased in a number of different jurisdictions. So I think that's pretty clear. And we also noted that the OECD's entry into this picture, and again, we were initially doing this work in mid-2013, and their work was still early on at that point, but it was becoming quite clear that as a collective body they were going to take on this issue as well. And I think frankly our biggest concern for companies that do appear to be acting more aggressively in terms of minimizing their corporate tax rate, our biggest concern for those companies relates to increased transparency and information sharing on tax. I think we all can kind of, I imagine most of us, I should say, would agree that we live in a world that expects transparency, and our view on is informed by sort of a lack of good information and tax footnotes, and that suggests that transparency on the tax side is somewhat low. And so in the end, we felt that governments and others had many paths that they could follow to really create some problems for companies that were being very aggressive for this. And so we started to then do the bottom-up work that we would do in sort of any other topic to try to understand this issue at a company-by-company level. So moving to slide 13, there were a number of data points that we used to analyze our holdings, and Valeria discussed some of these already, but our initial screen relied on an assessment of the tax gap. And we looked at that as just, again, the difference between the weighted average statutory rate for a firm based on its geographic revenue mix and the effective tax rate as just a way to get a sense for the companies out of our larger set of firms that we owned that we wanted to focus on. And if we found a large and persistent gap for a sizable holding, we would then dig into some combination of the other six areas that are listed here. And the key point being that this kind of analysis really needs to be very company specific, and it needs to be very detailed. I mean, you need to understand differences in the way a company will naturally earn profits in different regions. You need to understand the intricacies of each business and corporate strategy and competitive position and all this that you're looking at for the firm. So you can't separate this out and try to just use this as some rote exercise where you're going through and doing the same exact thing for each company. You really need to be flexible and understand how these topics might change based on the individual firm that you're looking at. Now, if you move to the next slide, slide 14, this is a diagram, and I'm not going to spend really much time on it, but this is the kind of information that we've put together for a number of different firms to really try to help us through taxation for our companies. So just trying to kind of step back and really think about, all right, for this particular firm, where should value be generated? Why do we feel confident that the value should be generated in that particular area? Then, what are some of the influencing factors that might cause profits to not be booked in the area where that value is being generated, and things of that nature. I don't, again, want to spend too much time on this slide or even moving to the next one, slide 15. Just another example of the way we've tried to kind of work this out in some different ways here. Each number represents a potential tax risk that we identified for this particular company as we went through and tried to get a sense for, where the different risks might be and how we might want to try to think about those or pose some questions around those potential risks as we talk to the management team within different conversations that we're having with them. But now let's move right on to slide 16 and talk about how we've integrated our tax work in our modeling and valuation. As I noted earlier, we don't always have the detail or transparency that we'd like on tax issues. So our adjustments are admittedly often rough, although that is true in several different situations. No financial model that any analyst creates will ever be completely accurate. But in many cases, what our team has done is just made direct adjustments to their base case effective tax rate modeling assumption for companies who we feel like are being more aggressive in their tax-related strategies. We'll make that assumption to bring it into a level that's in line with its peers, or at least our view of what we feel like a sustainable rate is likely to be for that company over the longer term. Now, in other cases where we have a lower level of concern, or where we feel like the firm's has a tax strategy that, while it may be aggressive, is also more likely to potentially be sustainable given the way that they've worked that strategy within different tax related constructs that we feel more comfortable with. In that situation, we'll generally look to implement a higher effective tax rate only in a downside scenario analysis as a way to just get a real sense for where the downside is for that security. I should also note that there have been a number of cases where we've used our in-depth knowledge on tax-related topics to be able to develop more positive views on certain companies as well. Companies that perhaps in the past have not spent much time focusing on tax-related issues and are beginning to and have an opportunity to lower their rate, again, in a way that does appear to be sustainable. So there have been times where we've adjusted upside scenarios or made downward adjustments to our base case effective tax rate modeling to account for teams that were being a little bit more careful in some of their planning activities, but again, not doing it in such a way that would cause us to view them as being more aggressive in their tax minimization strategies. Now, just as importantly, I would say we use our tax analysis to assess governance, and especially for companies that we feel like are pursuing very high-risk strategies or are just completely unwilling to discuss tax issues in any kind of transparent way. And this is something that we view, frankly, this idea of a board or a management team that's willing to act very aggressively as it relates to tax or their accounting policies or other indications. We really view that as a sign of potential excessive risk tolerance on the part of that board or management team. And to the extent that we feel like that's not aligned with us as likely long-term investors in that company, that's really going to impact most likely the way that we're valuing that firm and our willingness to own that firm. So now moving on to my final slide, number 17. This covers the work really that I've done to try to improve disclosure on tax, because I think one of the struggles that we have is it's not very efficient to try to have these conversations across a number of different companies. We'd much rather have the information that we'd like to see disclosed so that we can just access it in a very simple way. And so we've really focused on system-wide rather than individual company engagement, although we've, as I said, talked with dozens of companies on this topic. That was more information gathering than really truly what you might call, I guess, engaging, trying to encourage any kind of change at the company in terms of disclosure. So that's why I joined the task force for the PRI tax working group. And I really just want to note that we really value anyone's feedback who's on this call today on the PRI tax working group document. Please don't hesitate to provide it. We're very open to understanding different views on this document. I've also had some dialogue with the International Accounting Standards Boards regarding what I feel like is insufficient tax disclosure in annual reports. I just feel like the analyst community would benefit from having some improved disclosure, and so I tried to include some of I would say the 5 key areas that I think where I'd really love to see a better tax disclosure, and perhaps the most important one here is at the top of the list, the explanation of the foreign tax rate differential. I think that's one of the large line items within the tax footnote that you'll generally see, and it's typically not really broken out or described in any way really regardless of the region in which the company operates. That particular data point is not very well fleshed out, and I think that's something that is challenging for us to then try to understand as investment analysts. So instead of going through all of these, I think there are others that I could talk about, but I think I should just probably end it here, and then we can have some time for dialogue after everyone is done speaking. So I'll pass it back to you, Valeria.
Thank you, Robert. Thanks for your perspective. I think it's illuminating to see concrete analysis from investors and how it works. So thanks for sharing your experience. Before we move on to Clive's presentation, I just have a very quick reaction to what you just described. You mentioned that your average holding period is 7 years. You're definitely a long-term investor. But do you think that this is an issue only for the ethical-oriented one or the more long-term oriented one like yourself in your organization? Or do you think it's an issue that anyway any investor should care about?
Yeah, that's a good question. I think that certainly there are differences between ethical investors, long-term investors, short-term investors, and I guess I would say that certainly it seems like ethical investors are awakening to this issue a bit, and perhaps long-term investors are more likely to be doing this kind of research. But I suppose I feel, and having worked on some funds in the past that have a slightly, that have a shorter than certainly 7-year kind of average holding period, I think shorter-term investors may not really be, I guess, doing their clients any favor by ignoring these risks. I mean, the reality is that all risks happen at a point in time, and at that point in time, the shares are going to be owned by a large group of short-term holders who are going to be impacted by that risk. Now, a short-term holder, their reaction might be to just sell the shares and, chalk it up to bad luck or bad timing. But I guess I wouldn't view that as really an intellectually honest approach. I mean, I think if you look at a recent deal that was ended due to the new set of proposed rules from the U.S. Internal Revenue Service, certainly a lot of short-term holders owned the stocks that were, that were part of that M&A transaction. But would they have owned as much if they had been following the fact that, Treasury had said more rules were coming? I mean, maybe not. I don't know, obviously. We'll never know. But, if they had followed that as a risk, that might have helped them make a better investment decision, even though they're more short-term oriented. So do ethical investors, do long-term investors perhaps have greater reason to care about this issue? I would say probably, but that doesn't necessarily mean that that's the way it should be or necessarily even will be in the future as, more investors perhaps come to realize that this issue of tax is really being addressed in a lot of different ways.
Yeah, great. Thank you. I think it makes completely sense. It's probably something that everyone should care about, short or long-term oriented that they be. So it's the right time now to hear from Clive's presentation. Clive will be focusing a little bit about, of course, Merck's experience, but also provide us a little bit more feedback around the content of the guidance. So we're looking forward to hearing your perspective. Clive, the floor is yours.
Thanks, Valeria. So I'm Clive Baxter. I'm the head of group tax at Maersk. And for those of you not familiar with us, Maersk is a, if we're talking Fortune 1000 terms, we're a medium-sized conglomerate involved in oil industry related activities and transportation industry related activities, and we're active in 130 countries, so that makes us a pretty global organization. So I'd like to start by setting the scene, which is on the next slide, please. Yeah. These are what I see as the triggers for why we're even having this discussion today, and a lot of other discussions going on in the press and in different forums. Corporate tax payments have become a matter of public interest, and really, you know, I've been working in this area for longer than I care to remember almost. Certainly it was during the last millennium that I started, and really people were not very interested in corporate tax generally, apart from ourselves who are actually doing the tax work and the tax authorities who were auditing what we do. But then we had these big public debates starting, I think, in the UK, where we had a few major companies who were achieving a very low rate of corporate tax in countries where they had significant revenues. And this was all absolutely legal and above board. And then you have comments coming from politicians and other quarters, well, this may be legal, we don't think it's moral. And interestingly, we had a similar event a few years before here in Denmark, where the Danish Prime Minister made exactly the same comments about another legal tax saving that had been made. At the same time of this, we have the very well publicized leaks of confidential documents coming out of Luxembourg and Panama, and suddenly tax havens, secrecy jurisdictions, sweetheart deals, everybody's talking about them. And you know, 5 years ago, no one had really heard of these things. And again, we have NGOs focusing on the concentration of a large amount or share of the world's wealth in the hands of a small number of people, 62 being quoted as the number having the same wealth as the poorest half of the world. And is this somehow connected with this tax arena? Also, we have some focusing on low cash tax payments from multinationals compared to individual taxpayers in developed economies. So all these matters have come up in the public sphere. And if we can move on to the next slide, please. In my mind, we have a lot of confusion because there are different issues. They're all somehow connected with tax and who is doing what. And this brings confusion into our discussions. Who are the multinational enterprises? Is it the Fortune 1000? We people who work in these large global companies, if you talk about multinationals to us, we tend to think about the Fortune 1000. I see in the PRI guideline, there we're talking about any company with activities in more than one country. So that's a different kettle of fish. And when I say different kettle of fish, typically if you're dealing with a large listed company, there's a whole lot of regulatory obligations that you have to follow, and there is control over those. Once you get down to small private companies, there is a lot less regulation, a lot more possibility to do other things, which we'll come to in a minute. Who owns the multinational corporations? Is it these 62 people? Or is it actually the wealthiest half of the world through our pension savings? Which countries are the tax havens? There are at least a dozen different lists of which countries are tax havens. So what are we talking about here? And you know, in the public debate, is it the Fortune 1000 committing tax fraud in Panama? Or is it more obscure individuals with their private companies? Who's doing the tax planning in Luxembourg via what is popularly called sweetheart agreements? Is there any difference? And so on and so on. Can multinationals have secret cash hoards? Or is that just the high net worth individuals? You know, and on that, I'd comment: if you're a listed company, the only way you have a secret cash hoard is if someone's actually stolen it from the company. We cannot have unrecorded cash stashed away somewhere, because that's just not allowed by accounting or legal regulations. So in fact, we are easier to control if you're thinking of the tax authorities, because we cannot in the end hide our information. And again, why do individuals pay more tax than corporates? Who decided that? Is it the corporates who are just evading tax, or is the whole system actually set up in a way that typically the wealthy half of the world are going to end up paying more of the cash tax than the corporates? So there are many opinions on these various questions. I have mine, other people have others, and some of this confusion is really a result of a lack of communication. Let's move on to the next slide, which is the fallout for corporates like ours. There is this general atmosphere of mistrust of multinational corporations, which is out there in the press. There's a tightening up of international tax principles by the G20, the BEPS project that was talked about earlier, and make no mistake, that has huge consequences for multinational businesses. There's a massive increase in reporting requirements to the tax authorities, and a whole new set of restrictions on our freedom to act. And I'll add that was also the purpose of it. I mean, legislators have looked at some of the legal tax setups that had existed, and they said, well, sorry, this is going too far. We want to restrict your ability to do that kind of thing. There's pressure for more public reporting on tax, because people are saying, you know, we actually want to be able to see what you're doing. We feel that we don't like it, so tell us what it is you're doing. There's pressure from the NGOs for corporates to take over either the role or more of development funding by paying a fair tax. And as Robert was saying, nobody really knows exactly what that fair tax is. But I think that actually it is possible to reach some sort of consensus about what paying tax fairly is. Defining what the fair tax is that an amount, a percentage? But I think it's possible to reach a meaningful definition of what paying tax fairly is. And there's a lack of recognition, and I think it's our own fault, because we haven't really said anything about it, of our role in funding capital investments in manufacturing, infrastructure, training, education. You know, as Robert was mentioning, in developing countries, often they'll be lacking infrastructure, and we in the multinationals can invest in that, and I don't see that that's any less positive than paying more tax. But anyway, that's some views on this. But this is what's happened to our world. There have been major consequences. So let's move on to the next slide. Where does business stand in all this? And actually, business can stand anywhere around this circle. You'll find companies who completely refuse to discuss social responsibility and tax. There are others who will provide explanation if they're asked. There are others who really sort of build this in to their company's mission statement that they want to be responsible towards tax. So there's a whole lot of places, and if we just restrict ourselves to the Fortune 1000, they're all around the circle. So let's move on to the next slide. Now, here is where the what shall I call them? The aggressive tax setups stem from. I mean, income taxes came about during the beginning of the last century, and one of the early cases, the U.S. case, where you have the judge with the excellent name of Learned Hand, this is his real name, who said that anyone may arrange his affairs, so his taxes shall be as low as possible. And he also ends by saying everyone does it, rich and poor alike. And that was the view, and this is kind of a very legalistic view, that whatever possibility you have in the law to reduce taxes, you will do it. Now, did he really mean that you can set up your group in such a way that you pay whatever it is, 90% of your profits to a location where they're not taxed through a royalty setup? I'm not sure that's what he meant, but that's certainly the way some people see it. And then on my next slide, we have a view not from the legal sphere, but from religion, where we have Pope Francis writing to the British Prime Minister in relation to the G8 summit, where they're talking about BEPS, where he is complementing the commitment to deal with tax avoidance and ensure transparency, and saying ethics is not something external to the economy. Yeah, it's an integral element of economic action. Now, he's the leader of the Catholic Church, and not everyone's going to agree with what he's saying, but I put this in because this is not some obscure NGO or pressure group. This is a leader of one of the major world religions putting this thought. And actually, as far as I've been able to see, it's the whole thought that corporate tax avoidance, evasion, call it what you like, is a harmful thing, started with Pope Benedict, who actually thought it was a major cause of the financial crisis back in 2008-9. what is my conclusion from this? My conclusion is it's very difficult for business to ignore the fact that there is a view out there in the world, and you can look at the president of the IMF, you can look at the EU Commissioner for Competition. They're all sharing this view that there is a responsibility element to the way that corporations deal with tax. Let's take the next slide. So who decides what is responsible tax? There's a whole system around tax that we really can't get away from. The regulations are set by governments, and they decide what is the fair tax. They decide if they want to get their tax revenues from personal income, corporate income, by taxing property, or whatever it is. That's decided there, how they're going to allocate the tax burden. The tax authorities assess whether we followed the regulations. But then we have journalists, we have NGOs, we have political commentators. Yeah, they're expressing their opinions. They can't make a company pay X amount in tax. They can't decide what's the fair amount, but they do influence policy. We can see with the BEPS measure that they have been very influenced by the public debate. Corporations, and this is where I start to get a bit difficult, we don't decide what the fair tax is. And I'll also add that I've discussed this with the director of the Chinese tax authorities, and he was in full agreement that it was he who decided what was the fair tax, not us. We decide, though, what principles we're going to follow when we manage our tax obligations and payments, yeah, and they can be more or less aggressive. Let's take the next slide. So where are the investors? And this is my personal experience in Maersk. So I really don't know how general this is, but we get almost no questions from investors on tax policy or disclosure. And the only one we got last year was from an activist investor whom we know very well, who feels a duty to make sure that he keeps us on the straight and narrow path, and he does that very well. I haven't run into any awareness of PRI's guidance in my tax circles, but I think it's probably too early days, so it hasn't really reached me yet, this investor interest. But we do get a lot of questions. The questions that we've just been hearing about from Robert, we get these from journalists, NGOs, politicians, and our audit committee is following what we're doing with tax risk management, which in the past was not a great focus because they assumed that everything was being taken care of in a proper way. Now they actually want to know exactly how we're doing that, to protect, obviously, the company's reputation. It's possible more investor interest will come, because I think, as I just said, it's a bit early days for investors to focus on some of the things that Rob was talking about. At the moment, the pressure seems to come more from the NGOs, the CSR circles for information on how we're dealing with tax. Let's take the next one. So a few comments on PRI's guidance, and generally I think it's an excellent handbook for investors. who have an interest in evaluating what companies are doing with their taxes and their approaches. There's an assumption of an increasing interest from investors, which I'm waiting to see if that's going to come. So far, we haven't had that interest. Next slide. Rob's talked a bit about this point that some of the principles could lead to lower profits in the shorter term, and obviously a longer-term investor could take a different view. We've been very aware, and this is something that Rob was talking about, that there is a risk that if we engage in tax planning that's considered aggressive, then we can trigger legislative action that might actually be much more unpleasant than if we'd actually been a bit more restrained. And that I take as a good point for investors to consider. Let's do the next slide. I picked up an interesting point in the guidance that well, there's only 25% of the Fortune 1000 roughly companies that seem to have a large tax gap, and I think that's encouraging that actually most companies don't have this large tax gap. And this, I think, is a wake-up call to us, the 850, that we're not making our voice heard. We should be explaining what we're doing, that we're actually trying to meet our tax obligations. So the next slide. Oh, that's gone. It's here again. I say here for this part of the guide that it's important for investors and companies to engage with each other to get a common understanding. That I think is what we're trying to do today. Next slide. So what are we doing in Maersk? We're in Denmark, which is a small country. We have a prominent position. So our tax affairs have always been under public scrutiny. And our approach has been to follow the requirements of the law, but also to steer clear of artificial structures. Yeah, so we tried to align our tax strategies with our commercial drivers. We formalized that approach in a tax policy in 2010. We report to our group CFO and the audit committee on how we're approaching tax risks, and on ad hoc basis to the audit committee chairman. Next slide. We started to talk about tax in our sustainability report, which was for us a big change. We decided not to put this extra information in our financial reporting, but instead to include it with sustainability. After years of being unknown, I appeared in our group magazine to explain what our tax policy is, and we've actually made significant efforts to actually spread the knowledge of how we should be dealing with tax throughout the group. We're currently looking at publishing some more data on tax payments. We may decide to wait for the EU regulations. We have a concern about giving too much information to our competitors who don't have to make the same disclosures, and that is what we're looking at, how we're going to handle that. Next slide. We set up 11 country tax centers to improve our compliance, and we've also begun to get involved in the public discussions about tax. We appeared before the Parliamentary Tax Committee discussing tax treaties in relation to developing countries. We're
I think we have a problem to hear Clive now. It might be something with his microphone or his connection. Clive, can you hear us?
This is Rob. It appears that perhaps Clive is dropped off the line. Are there questions that perhaps from the audience that I might be able to provide some perspective on while we wait to see if he can connect again?
Yes, that's a good idea, Robert. Thanks for suggesting it. Actually, we got a question while you were speaking, which is quite interesting. I don't know if you have an answer, but it would be interesting to know more about that. There was a question around if there's any evidence of correlation between board diversity and tax policy. So is there any evidence that actually having a diverse board means less risk? Have you ever looked at it?
Yeah, it's an interesting question. I certainly have not had that. I have not done that level of analysis to try to determine if there is a correlation. I mean, what I would say, I have spent some time on board diversity, and it's part of the way that we view and assess sort of moving away from calling it governance and moving towards calling it board culture and risk tolerance is the way that we're trying to think about the topic, and I think board diversity is really critical in understanding board culture. And as you look at the research that is out there on board diversity, you can see that there is a connection between board diversity and lower volatility in stock returns. So there's been some academic research that has suggested that board diversity does lead to lower volatility in stocks, and I believe it's Morgan Stanley as well that's also recently published some work on that same kind of topic, showing that same reduced volatility as a result. So I think if you were to dig into it, you would probably find that perhaps board diversity does help with assuring a thoughtful stewardship of the company in general, and I imagine that would flow into all kinds of areas like the accounting policies and tax policies used by a particular firm.
Great, thank you, Robert. I think we got Clive back for a moment. I don't know if he's still on the line. He was about to wrap up his presentation, so I hope we haven't lost too much about his remarks. Clive, I think there's a lot of background noise if it's you now. Unfortunately, I don't think we can hear you. So maybe just one final question for you, Robert, and I think at that point we will have to wrap up the call. You touched base already on a few things that you're doing to try to increase the level of disclosure from the companies, and I think that's kind of a level of feedback that we got until now on the guidance too, and I think Clive was also very interested in understanding a little bit more about that, because investors use a combination of data, research, logic, but also a little bit of intuition and red flags to understand if there are risks related to tax. So what do you think is the right level of disclosure and transparency from companies for investors to be able to make decisions?
Yeah, well, I think that's a really good question because, I mean, there are going to be differing needs, I would imagine. I'm guessing that there are probably two things that are needed, and the first is probably, or from my standpoint at least, I would say this is the first, is more or better quantitative information and details around things like that foreign tax rate differential, as I mentioned. It's a very large number. It's not explained in any way, and having that in the actual 10Ks in the United States, annual reports overseas, that's the place where analysts go and look for their information. And so having more data in those locations to describe that critical number would be quite helpful, I believe. On the qualitative side, I think it's, it would certainly be helpful to have a clear outline of the tax practices that companies use and those that they don't use. So if you're a company that's looking to craft or you have a tax strategy internally, thinking through what parts of that you could articulate in a public way to, as Clive was saying, be able to be part of that dialogue and say, hey, here are the places, here are the things that we're not doing to give investors or the media or more ethically focused individuals the ability to say, okay, well, these are some critical areas that perhaps I have concern about as an individual, or whomever it may be that's raising that concern, and they could see very clearly that's not something that this particular company uses, and the reasons why the company's not using that, I think could be really helpful. So I think it's going to be a mix really of some more quantitative information in the actual financial statements, but then also there'll be many who benefit from a more qualitative discussion of tax practices and strategy within the firm as well.
Thank you, Robert. That's great. I really hope we inspire people during this call. I would like to thank you. I would like to thank Clive. And sorry, Clive, if we were not able to hear you and your final comments. I think there's some problems with the line, but I would encourage everyone in the call, if you have specific questions for Clive to answer, please get in touch with the UNGC. I'm sure he will be more than happy to answer these questions by email and separately. So I think we're at the end of the webinar for today. You will be able to also download the recording of this call on the website from the UNGC. And from the PRI, I would just like to reiterate the message that Robert also shared with us during his presentation. We want to hear your perspective. We want to hear what the companies think about the guidance. Have we touched base on the right kind of questions? Are there some concerns? Are we missing something? And I think Clive has been fantastic in providing us with very detailed information and feedback on the guidance. We would love to have something like that from other companies from UNGC. So please get in touch with us and provide your feedback. On our end, we will make sure that we will raise awareness of the guidance to respond to what Clive said in terms of not hearing enough from investors on these questions. So thanks a lot for your attention and have a nice afternoon.